Welcome to Breaking News to Trading Moves.
Today we're looking at a pretty strong report from Urban Outfitters.
Yeah, and we're not just focusing on how one company performed. We're looking at what their success might tell us about the whole fashion retail landscape.
That's right. When a retailer like Urban Outfitters, that's URBN, puts up numbers that beat expectations, it makes you reevaluate everything.
You have to look at consumer behavior, who's winning, who might be losing.
Exactly. We have a lot of analysis here, and the plan is to look at what made URBN's quarter so good and then use that to, get a better view on other retailers.
From youth brands all the way to luxury activewear.
And even those circular economy platforms.
So the main point is, Urban Outfitters had a record third quarter. And that strong performance is now seen as maybe a validation of certain consumer trends that affect almost everyone else in this space.
Right, whether you're a rental platform or a traditional department store.
So let's get into the specifics of that report, the details that are making investors maybe rethink their strategies.
Okay, let's start with the hard numbers. The headlines look good. Revenue growth was up around 12% year on year.
And same-store sales were strong too?
Very strong across their main brands.
Yeah.
And they also delivered what's called a beat on earnings per share. But I think the mechanics behind those numbers are actually more telling than the figures themselves.
Okay, so when you say mechanics, what do you mean? What parts of their sales structure tell us the most about the consumer right now?
I point to two things. First is margin protection.
Okay.
So the company didn't just move more product. They grew their sales volume, and they did it while cutting back on markdowns.
And that's the key thing here.
It is. It signals that their inventory was in a good place and that shoppers were, willing to pay close to full price for the items.
So it's not a story about just clearing the shelves with big sales. It's about successful product and real pricing power.
Exactly. When a company can avoid heavy promotions, it shows they're getting the trends right and their inventory management is on point.
It means their customers aren't just hunting for bargains.
Right. They're looking for that specific style that Urban Outfitters or its other brands are offering. And when people are willing to pay full price, that changes the calculation for everyone else competing in that market.
And you said there was a second critical detail.
Yes. The Nuuly factor. This is Urban Outfitters' rental business.
Ah, right.
Nuuly saw a jaw-dropping jump in subscription sales. We're talking about 49%. And a big increase in active subscribers to go with it.
Wow.
So this is more than just a little side project. It shows the fashion rental concept is really gaining ground and becoming more mainstream.
It's a real growth driver.
A proven one. It can command high engagement and loyalty.
A nearly 50% jump is a powerful number. It suggests the circular economy model isn't just an idea anymore. It's a measurable revenue stream.
Absolutely. The success of Nuuly doesn't just validate Urban Outfitters. It validates the whole idea that people want flexibility and variety without, the commitment of buying something.
They'll pay a monthly fee for that.
They will. It's a behavioral change that goes way beyond just URBN's balance sheet.
Okay, so if full price strength and a booming rental business are the positive signs, then who else in the sector is set up to benefit from this? Let's talk about the potential winners.
Right. We can group them into three different categories based on which part of the URBN success they seem to mirror.
Let's start with the first one. Youth and lifestyle fashion retailers. The core Urban Outfitters brand had strong comparable sales, which suggests that younger shoppers are out there spending money on trendy clothes.
Yeah, this is all about shared demographics. If URBN is hitting the mark with late teens and college-age kids, then other stores with a similar customer base and mall presence should also feel that lift.
The demand seems healthy for that group.
It does. So besides URBN itself, the analysis points to a name like American Eagle Outfitters, ticker AEO.
Okay, that makes sense.
They really operate in a similar world. The specific clothes might be different, but the overall health of their shared customer, which we just saw in URBN's full-price sales, gives AEO a better outlook.
Got it. What about category 2? Premium and activewear lifestyle brands.
So the success wasn't just in the core youth brand. Anthropologie, Free People, and their activewear line FP Movement all grew.
Which suggests the consumer who's paying full price for trendy stuff is also willing to pay up for more specialized lifestyle and activewear.
This is where pricing power comes in. The growth in Anthropologie and Free People shows that consumers with more disposable income are choosing unique, higher quality goods. They're not being forced to trade down to cheaper options.
So it confirms that the premium end of the market is holding up well. How does Anthropologie's success connect to, say, a company that only does high-end athletic apparel?
Well, it validates this idea of aspirational buying that's tied to a brand's identity, not just its function. If an Anthropologie shopper will spend more for a certain lifestyle feel, then it stands to reason that a Lululemon customer, ticker LULU, is also likely to keep spending on their favorite high-end activewear.
So we're talking about companies like Abercrombie and Fitch, ticker ANF, and Lululemon, LULU. The thinking is that consumer loyalty to quality brands is strong.
Precisely. A&F has done a good job pivoting to a more adult aspirational style, which kind of mirrors what you see at Free People and Anthropologie.
And Lululemon.
Lululemon just continues to lead the premium activewear space. Their ability to charge higher prices is supported by this general willingness from consumers to pay for quality, which we're seeing in the URBN numbers.
Okay, and that brings us to the third group of potential winners, which comes straight from that Nuuly success story: fashion rental and circular economy companies.
Yes, that 49% jump in subscription revenue, like we talked about, it really validates the entire model.
For years, there was skepticism, right, about whether these platforms could scale, the costs involved.
All of that. Nuuly's performance helps to quiet a lot of that doubt. It shows there's a huge appetite for renting and reusing fashion.
And that the logistics can work.
They can. And the customer acquisition seems to be sustainable.
So this helps the pure play companies in that space, even if their business models aren't exactly the same as Nuuly's.
Absolutely. The analysis points directly to Rent the Runway, ticker RENT, and the Real, ticker REAL.
RENT for rentals and REAL for resale.
Exactly. Nuuly's growth proves that the way people shop for fashion now includes non-ownership models. The whole market for these companies seems to be expanding quickly.
Okay, so that's a pretty clear picture of the winners. Companies with healthy youth demand, premium pricing power, and a good circular model. But retail can be a zero-sum game.
It often is, yeah.
If one group is gaining market share, another group is probably feeling the pressure.
That's the other side of the coin. The success of a specialty retailer, especially one with strong brands, is generally not great news for other parts of the market. So now we can look at the short ideas, the potential underperformers.
All right, let's start with what feels like a perennial one: traditional department store chains. Why does this URBN report specifically add to the pressure they're feeling?
Because URBN is saying they're taking market share, and they're doing it with a clear brand focus.
Unlike department stores.
Right, department stores like Macy's, ticker M, and Kohl's, KSS, are built to be generalists. They don't have that single focused identity or the kind of in-store experience that a specialty retailer like Urban Outfitters can create.
So they get caught in the middle. They can't match the specific trends of URBN, and they can't match the low prices of a true discounter.
Exactly. They get outmaneuvered. When a shopper is willing to pay full price, they go to the specialty store for that specific item they want. When they want a bargain, they go somewhere else.
And the department store loses out.
Their lack of differentiation makes them vulnerable in this environment.
Okay, what about the second category? Off-price apparel discounters. This one feels a little less intuitive. Don't discounters do well when people are feeling squeezed?
They do, but this goes back to that first key metric we discussed.
URBN cutting markdowns.
Yes. Off-price retailers like Ross Stores, that's ROST, and Burlington Stores, BURL, they depend on two things. One, a consumer who is purely chasing the lowest price.
And two,
an environment where other retailers are forced to dump their excess inventory.
okay. So if specialty retailers like URBN are selling their stuff at full price, there's less high-quality brand name merchandise for the discounters to buy up.
Precisely. The off-price business model depends on those windfalls of distressed inventory. If the specialty stores are managing their inventory well, the discounter selection becomes less appealing.
Or they have to settle for lower quality goods.
Which can turn customers away. It really puts a dent in their advantage.
That's a subtle point. The success of full-price selling higher up the chain hurts the inventory pool lower down.
It does. It suggests that while some shoppers are under pressure, enough of them are prioritizing quality and specific products to affect the traffic at off-price stores.
Okay, finally, let's look at the third category for the downside. Online-only fashion platforms. URBN showed that a mix of physical stores, a strong website, and now rental. That's a winning formula. Why is that a problem for the pure digital players?
Well, retail today is all about having multiple ways to reach the customer. A physical store is still a very powerful tool for advertising and brand building.
Something an online-only player doesn't have.
Right. Companies like Revolve Group, ticker RVLV, or Stitch Fix, SFIX, they rely only on the digital experience. And that means their costs to acquire new customers through online ads can get very high very quickly.
They don't have a mall location to just draw people in.
Yeah. Exactly. URBN proved that this integrated, multi-channel approach is working right now. The pure online players lack the stores, and they certainly lack the rental piece that URBN is leveraging so well.
So it's harder for them to get attention and grow without spending a ton on ads.
Especially when URBN is pulling customers into its world through 3 different doors: retail, digital, and rental.
So to sum it up, this strong quarter from URBN shows us that consumers are spending on trend-driven youth brands, they're sticking with premium labels, and they're quickly adopting circular options like rental.
And that's putting pressure on department stores, on off-price retailers that need inventory, and on the online-only platforms.
It really creates a new set of expectations for investing in this sector.
It does. The playbook for success in fashion retail is changing, and it seems to reward brand focus and agility.
I think the most compelling piece of this whole thing is the speed of adoption we're seeing with Nuuly. That 49% growth changes the whole conversation.
I agree. And that growth leads us to our final thought for you to consider today. Given how quickly the rental model from URBN has been accepted, how long will it be before other big retail chains, ones that don't have a rental or circular option right now, are forced to build one just to stay competitive? It suggests a big investment cycle might be coming for anyone who's behind.
A very compelling question about the future of the whole retail industry. Thank you for walking us through all this.
My pleasure.
And before we go, we need to remind you that the information discussed today is based solely on the material and analysis we reviewed. This is not financial advice, nor is it a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the material reviewed.